Before we start the video, I want to mention we do a Bitcoin giveaway. $200 when we hit the first 1,000 subscribers. Like and subscribe to win. Imagine waking up one day to find that the financial world you once knew has crumbled like a house of cards. Your bank, once a symbol of security, is now on the verge of collapse. This is not the plot of a Hollywood thriller, it's the reality of the 2023 bank crisis, and in this video, we will try to understand the intricate web of events that led to this crisis, while also exploring the ripple effects it has sent across the global financial landscape. A banking crisis is not just a phrase tossed around in economic discussions. It's a reality that can send shockwaves through nations. But what exactly is it? At its core, a banking crisis is like a domino effect. Imagine a row of dominoes standing tall, each one representing a bank. Now imagine a gust of wind shaking the first domino, causing it to wobble and crash into the next. The chain reaction begins, and soon the entire row falls with a resounding crash. In the financial world, the dominoes are banks, and the gust of wind is a series of unfortunate events that undermine their stability. It could be poor risk management, economic downturns, or a lethal cocktail of both. When banks lose their balance, panic sets in. Depositors, individuals like you and me, start to worry. Is our money safe? Can we trust the bank to keep our hard-earned cash secure? We will answer this question shortly, but for now, let's fast forward to 2023, a time when headlines are buzzing with news of a banking crisis, the fall of American banks. If you're a seasoned investor, you might have just heard the news. First Republic Bank, a financial institution you've trusted for years, has collapsed, but that's to say the least. Other banks like the Silicon Valley Bank have also taken the hit, and the downfall of these American banks is a shocker. According to Investopedia, the collapse of First Republic Bank was a result of a series of poor decisions, including risky investments and a lack of adequate risk management. Forbes adds that the bank's failure was a timeline of missteps, making it the second largest bank collapse in U.S. history. But it wasn't just poor decisions that led to the fall. The 2023 banking crisis in the U.S. was primarily caused by aggressive interest rate hikes by the Federal Reserve, according to a research paper by Peterson K. Ozili. These hikes led to massive losses on government bonds held by U.S. banks. The losses triggered fears of bank collapse and unprecedented deposit outflows, leading to liquidity problems for some banks. First Republic Bank was one of the 4 banks that eventually collapsed, along with Silicon Valley Bank, Signature Bank, and Credit Suisse. The crisis revealed hidden vulnerabilities in the banking system, unmasked by the increase in interest rates. European banks, Credit Suisse, and Deutsche Bank. Now, let's hop across the pond to Europe, where the financial landscape has been shaken by the dramatic collapse of Credit Suisse, a once revered Swiss multinational investment bank. The downfall of Credit Suisse wasn't a sudden event, but rather the culmination of a series of financial missteps and controversies that rocked the core of the institution. Credit Suisse's troubles began with its ill-fated involvement with Archegos Capital Management, a family office that engaged in risky trading strategies. The bank's exposure to Archegos's high-stakes bets left it vulnerable when the bets went sour, leading to massive losses. This incident alone was enough to send shockwaves through the financial world, raising questions about risk management practices at the bank. Moreover, Credit Suisse's involvement with Greensill Capital, a financial services company specializing in supply chain finance, further deepened the crisis. The bank's close ties with Greensill exposed it to the fallout when Greensill faced insolvency. Credit Suisse had to suspend funds linked to Greensill, leaving investors in limbo and further eroding the bank's reputation. Meanwhile, in the heart of Germany, Deutsche Bank, one of the largest financial institutions in the world, faced its own set of challenges. Despite the reassurances of its CEO, Christian Sewing, the bank's situation remains precarious. Deutsche Bank's struggles are not isolated, but rather reflective of the broader issues plaguing the banking industry. The bank's journey through the 2023 crisis has been marked by a series of events that have tested its resilience. Shares of Deutsche Bank experienced a significant slump on world exchanges, a clear indicator of the market's lack of confidence. The cost of insuring the bank's bonds against default surged, underscoring concerns about its stability. The easy money policies of the Federal Reserve have also played a role in Deutsche Bank's predicament. The relentless quantitative easing and near-zero interest rates have led to a boom-bust cycle that, as predicted by Deutsche Bank's experts, is steering the U.S. toward a recession. The ramifications of this cycle are felt globally, and Deutsche Bank's fate is intertwined with this economic roller coaster. According to CNBC, Deutsche Bank was initially considered safe compared to Credit Suisse. However, The Economist reports that the sell-off started with Deutsche Bank, whose shares fell by 14% as investors dumped them. The Euro Stoxx 600 Banks Index, which contains the region's biggest lenders, lost 5% in a single day. After the collapse of Credit Suisse, investors were left wondering if another fateful weekend lay ahead for Deutsche Bank. Christine Lagarde, the president of the European Central Bank, assured that Europe's banks were liquid enough to withstand market scrutiny. But the question remains, how serious are the difficulties we are facing? The bank has been dogged by trouble over the years, and its credit default swaps jumped to near record levels, causing fear to spread across the European banking sector. Risks and consequences. So what's next? What are the risks and consequences of this banking crisis? According to the U.S. Government Accountability Office, customers with uninsured deposits may be more likely to withdraw their funds during times of economic uncertainty. This could lead to a run on the banks, exacerbating the crisis. The Conference Board suggests that although the worst of the banking crisis appears to be over, stress in financial markets remains. Banks are still borrowing from the Federal Reserve to stay afloat. The crisis has been triggered by a range of factors, including rising debt levels, low interest rates, and the ongoing impacts of previous financial crises. The risks are manifold, from individual financial ruin to a potential global economic downturn. The consequences could be far-reaching, affecting not just the banking sector but also the broader economy, from employment rates to consumer spending. This unease can also escalate into a full-blown bank run, a scene straight out of a movie. People rush to the bank, forming long lines, desperate to withdraw their money before it's too late. It's a self-fulfilling prophecy. The fear of a bank collapsing can actually cause the collapse. The more people withdraw their funds, the weaker the bank becomes, and the cycle continues. In a world where money makes the gears turn and banks are the guardians of our hard-earned cash, the 2023 bank crisis has shaken the very foundation of trust. As the dust settles on the ruins of financial giants and economies tremble, a crucial question lingers in the air. Can we rebuild what's been broken, or are we on the cusp of a new financial frontier? As we navigate the uncharted waters of uncertainty, one thing is certain. The story of the 2023 bank crisis is far from over, and its chapters are being written by the actions we take today. Will history remember this as a turning point, a warning, or a story of a rise from the ashes? Tell us what you think would happen in the comments below. If you liked the video, please consider subscribing and sharing so we can keep bringing more content like this. See you next time.